All right, let's just cut through all the noise for a second and look at the data. In a market that's just flooded with earnings calls and analyst chatter, the real signal, the real alpha, it's not coming from Wall Street. It's being broadcast loud and clear directly from Washington, D.C. And if you know how to read it, well, it's one of the most powerful tells in the entire game.
And that brings us to the fundamental question, right? Is all of this just random, or are there players out there who are basically reading the script before it's released to the public? Now, let's forget all the conspiracy theories. This is about identifying a statistical divergence. It's an anomaly where you see specific actions that consistently come before predictable outcomes, and that right there, that's the edge.
And this is the catalyst. A piece of legislation that some have nicknamed the $3.3 trillion Big Beautiful Bill. Now look, this wasn't just another spending package. This was a government-mandated realignment of capital. An event this big doesn't just make a few headlines. It creates these huge, predictable waves of liquidity. And our job is to follow those waves.
So here's the game plan. First, we're going to deconstruct this $3.3 trillion anomaly. Then we'll map out the policy profit pipeline. Third, I'm going to show you exactly how you can track this smart money for yourself. And finally, we'll weigh the bull and the bear case. Let's dive into the data.
Okay, Section 1. The $3.3 trillion anomaly. So when a bill of this size actually hits, it's like a tectonic shift for the market. It creates a really clear, predictable list of winners and losers. All that liquidity, it has to flow somewhere, so let's follow the capital.
Just look at this breakdown. This policy mandates a massive capital reallocation. We're seeing huge cuts to programs like Medicaid and clean energy. So the question is, where does that capital rotate to? Well, it goes to increased spending in key areas like defense and border security. See, this isn't a market trend. This is a government-mandated sector rotation.
And this just perfectly illustrates the immediate outcome. So the winners? Defense contractors. Think Lockheed Martin. Surveillance tech. Think Palantir. And traditional energy giants like Exxon. And the losers? Well, EV companies like Tesla are losing tax credits. And renewable firms like NextEra Energy are facing way less federal support. The investment thesis basically writes itself, based purely on the text of the legislation.
So knowing the winners and losers, where did the informed money flow before the public ever heard about it? The data on these pre-legislation congressional trades shows a really clear anomaly. Just look at the heavy concentration in banks and defense. That is not random market noise, people. That is a signal of high conviction positioning.
And here are the receipts. A 97% return on Palantir, a direct beneficiary of the bill's surveillance funding, an 80% return on GE, a defense and energy titan. The data here is just undeniable. Your proximity to policy seems to correlate with superior returns. Now let's break down the mechanism that actually makes this possible.
Let's move to Section 2 and see how this all connects. We've seen the what. Now let's analyze the how. This is what we call the policy profit pipeline. It's the process by which a bill on Capitol Hill turns into a major liquidity event on Wall Street. The whole framework for this is called policy intelligence, and to be crystal clear, this is not about illegal insider trading. It's about systematically analyzing the legislative process and its downstream economic impact. It's really about recognizing that government policy is arguably the single most powerful catalyst for sector rotation in the entire market. And hey, it's not just us watching. Industry leaders are signaling the exact same thing. When the CEO of Chevron states publicly that there's no cohesive energy policy, what he's really doing is broadcasting uncertainty. And for traders, you know what uncertainty equals? Volatility. And volatility equals opportunity. So how do the most informed players navigate this?
They de-risk. We see a really clear pattern here. Lawmakers with direct insight into these policy debates are selling shares of energy majors like ConocoPhillips and Chevron. Now, this isn't panic selling, it's a strategic reduction of their exposure ahead of what they see as predictable policy headwinds. This is the policy profit pipeline in action. Which brings us to our third section, how you can actually apply this stuff. This is about moving from just observation to a repeatable strategy. So here is a framework for tracking Washington's smart money and aligning your own strategy with these incredibly powerful institutional flows.
Look, the framework is simple and it's repeatable. Step 1, identify the policy catalyst. Step 2, analyze the legislation to find the clear winners and losers. Step 3, track the public data on institutional flows to confirm that capital rotation. And step 4, assess the setup for an asymmetric risk/reward opportunity. That's it. Okay, so let's apply this framework to energy right now. The bull case, which is supported by both current policy and industry forecasts like this one from Exxon, it points to a durable, multi-year theme. This is basically the consensus institutional view.
But listen, every thesis demands a stress test, and the primary bear case here is pretty simple. It's political risk. A new administration could completely reverse the current policy, creating massive tailwinds for renewables and, you guessed it, severe headwinds for fossil fuels. This political variable is the single most important factor you have to monitor.
And that leads us perfectly into our final section, weighing the bull versus the bear case. A truly data-driven approach means you have to acknowledge both sides of the trade and understand the risks just as clearly as you see the opportunity. So here's the bottom line. The bull case is this. Following these informed capital flows gives you a real statistical edge, and major policy tends to create durable, multi-year themes. The bear case? Politics are volatile. A thesis can be completely invalidated overnight by a changing political landscape, and headline risk can trigger some extreme volatility. You have to weigh both. Now, it is absolutely essential that I state this clearly. This analysis is for educational purposes only. It is based on public data that changes, sometimes very rapidly. You must always do your own due diligence before making any investment decisions.
We are tracking these flows in real time. While you analyze the next move, check out the tools in the description. Sign up for Public to get $20 in free assets, check Webull for that BTC promo, or look into NVDA on Moomoo. Links are down below. Like and subscribe for more deep dive analysis.
So, the data is clear and the framework is right there on the table. The only question left is this. Are you positioned for the next policy shock? Because make no mistake about it, it is coming. Stay disciplined, stay liquid.